Hi there. Today we're diving into one of the most famous and probably most misunderstood terms in the world of investing, the stock. This video will explain how stocks work, what makes them different from each other, how people make money with them, and why their prices can be as wild as a roller coaster ride. Stick around until the end to learn how to avoid losing money when investing in stocks and the common mistakes beginners make. Don't forget to support the channel with a like and a subscription. A stock isn't just a piece of paper with a company's logo or a number in your trading app. It's a piece of a business. When you own a stock, you own a part of the company. That part could be tiny or quite significant, depending on the total number of shares the company has issued. The meaning of your investment depends entirely on that ratio. Think of it this way. If the company is a pie, then a stock is one slice. However many slices you own, that's how much say you have in the company's profits, decisions, and even what's left over if the business ever shuts down. Imagine you and your friends decide to open a coffee shop. One of you invests $1,000, another puts in $2,000, and a third invests $7,000. You divide the business into 10 shares. You get 1 share, the others get 2 and 7. That's basically how stocks work, public versus private companies. The difference is huge. Public companies are the ones whose shares are traded on the stock exchange. Private ones don't go to the capital markets. They work with a limited group of owners. There are way more private companies out there, you just don't hear about them. Some of them are huge, but they don't have to report to shareholders on the open market. Public companies, though, those are the ones you see in your brokerage app. But here's the catch. Becoming a public company is expensive and complicated. So companies only go public when they need serious funding. An IPO is like the company's coming-of-age moment. Before that, they might be a startup, a lab, or a small team of enthusiasts. Afterward, they're a player on the global stage. Join our Telegram channel where we post updates about new videos and articles. You'll find the links in the description or the pinned comment. Now think about this. If you have 100 shares, is that a lot? The answer depends on the total number of shares. If there are 1 million shares, you own just 0.01%. But if there are only 1,000, then you own 10% of the business. That's why it's so important to always know the total number of shares. It's not about the absolute number. It's about your slice of the pie. It's easy to issue 1 million shares instead of 1,000. That makes each share worth less. Some companies do this on purpose, to keep their stock price low, just a few dollars per share. Others don't split their shares at all. For example, 1 share of Berkshire Hathaway costs hundreds of thousands of dollars. That's because Warren Buffett never did a stock split. He didn't want short-term speculators among his shareholders. Let's talk about your rights as a shareholder. What do you get when you own stock? First, you're entitled to a share of the profits. That could come as dividends, regular payouts, or through capital appreciation when the company grows and your shares grow with it. Second, you get voting rights. For example, you can vote for the board of directors. And third, you have a right to a portion of the company's assets if it goes out of business. Of course, banks, the IRS, and creditors come first. But still, not all stocks are created equal. Some are common, others are preferred. Preferred stocks usually pay fixed dividends, but they almost never come with voting rights. Think of them like bonds with perks. Some stocks also carry different voting powers. For instance, startup founders might keep special shares that give them 10 votes per share. It's a way to keep control. So why do companies issue stock? To raise money without taking on debt. The alternative is a loan, and loans mean interest. With stocks, you sell part of your business and get cash in return. Sure, you share future profits, but you don't owe anything back. That's one of the main reasons companies go public. To scale without the burden of debt. An IPO, or initial public offering, is when a company offers its shares to the general public for the first time. Before the IPO, Only the founders and maybe some venture capital funds owned shares. Afterward, anyone can buy them. Going public involves marketing, accounting, legal checks, and of course, public interest. Big investment banks serve as underwriters. They guarantee the offering and earn millions doing it. After the IPO, the real life of a stock begins. Its price changes every day, sometimes every minute. Why? Supply and demand. The more people want to buy, the higher the price. The more they want to sell, the lower it goes. But demand is influenced by everything: earnings reports, news, rumors, even social media. Yes, a single tweet from Elon Musk can make a stock crash or skyrocket. The market runs on emotion. It's not always logical. Sometimes stocks go up even when profits go down, or the other way around. It's about expectations, sentiment, and investor confidence. People look to the future. They weigh not just the numbers, but also the outlook. Will the company expand? Will there be a new CEO? Is a competitor entering the scene? Want to know the two main strategies for making money with stocks? First, capital appreciation. Buy low, sell high. Sounds simple, but it takes serious analysis. Second, dividends. Some investors only buy dividend-paying stocks to generate regular income. But not all companies pay dividends. Young, fast-growing firms prefer to reinvest profits, opening new offices, launching new products, expanding globally. That's the playbook for tech giants. They're betting on growth, not immediate payouts. And that's a strategy too. Earn from price gains instead of income. Now imagine you bought a stock for $50. A year later, it's worth $70. You've made $20 per share if you sell. But if you hold on to it and the company pays dividends, that's extra cash. Some stocks can be worth hundreds or even thousands of dollars after a few years. That's how long-term wealth builds up. We've just published a new article on our website. You'll find free content on stocks, bonds, and ETFs for everyone from beginners to advanced investors. Go check it out and bookmark the page. But the story doesn't end there. Once a company goes public, it enters a new phase: life under the microscope. Financial reports are now public. Every quarter, they have to release results, answer investors' questions, and justify their actions. Mistakes are on display. So are wins. The stock's market value now moves daily. Investors judge them like actors auditioning for a role. Big funds, banks, institutional investors, they watch companies closely. Their decisions can move stock prices just as much as news can. If a pension fund dumps a bunch of shares, the price can tank. If they buy, it can shoot up. That's how the big game works. But let's be real. Investing in stocks carries risk. Prices can drop. Companies can go bankrupt. You could lose money. That's why having a strategy matters. Don't put everything into one stock. Remember diversification. It's like eggs in a basket. Drop one and the rest survive. The stock market can be volatile. That means prices can change fast and without warning. Yesterday it was $100. Today, $85. Tomorrow, $120. That's normal, especially in uncertain times. The key is not to panic. Know why you bought the stock. If it's a long-term investment, short-term swings shouldn't stress you out. External factors matter too. Geopolitics, tax changes, interest rates, they all affect the market. Sometimes just one sentence from the head of the Federal Reserve can send the whole market soaring or crashing. Psychology is huge. Investor confidence isn't a number on a spreadsheet. It's fragile and always shifting. It can push the market to all-time highs or drag it into despair. Panic causes sell-offs. Greed creates bubbles. That's why experienced investors say, buy when there's fear and sell when there's hype. Now picture someone buying their first stock. At first, their investment grows, then suddenly a drop, they panic, they sell. A week later, the stock rebounds. They miss out. That's a classic mistake. Knowledge, patience, and discipline are key. So is understanding your strategy. You might be a growth investor, going after fast-growing companies, or a dividend investor, picking stable companies with a strong payout record, or maybe you're a trader, chasing price swings. Either way, knowing the basics is the foundation. Stocks aren't a casino. They're a tool to allocate capital efficiently in the economy. Today, thanks to the internet, anyone can open a brokerage account and buy a stock. You don't need to be a billionaire. You can start with $10. What matters is that you start with clarity. You can support your favorite company, invest in ideas you believe in, and be part of the global investing world. Stocks aren't just about making money. They're about being part of the economy. You're investing in stores, factories, innovation, and technology. You're part of the future. And the more you understand how it all works, the more confident your journey becomes. Like this video and subscribe to the channel. Support our work on the membership platform. Link in the description or pinned comment.